we'll move right to Matteo Benetton's presentation, and which will actually consider sort of a very related set of questions with a very different research design and empirical setup. So, so Matteo, floor is yours. Why don't you share your screen, and then we'll kind of bring the two together in the Q&A at the end.
Thanks a lot again, Johannes and Teresa, for the invite. I'm super happy, as many of you did today, to go back to the job market paper and chat a bit more about it. And again, for the students, take now a virtual plane to go back to the UK and to some structural type work. So I don't think by now I have to convince you why we care so much about the mortgage market, the main liabilities for households in developed and also some developing country, and they've been really at the origin of the financial crisis. Now, after COVID, we need to say the previous crisis. So again, not surprisingly, I think Johannes mentioned at the beginning today that both academics and policymakers, and some of the academics just fresh out of PhD or during their PhD, started to think about this type of regulation, and Anthony just gave an example of a fantastic paper. Big if you want, thought and goal behind this regulation: limit exposure to the real estate sector, both with more supply side type of regulation like risk-weighted capital requirement, or more demand side type of regulation like limiting household leverage, like loan to value, loan to income, or debt to income. However, back then, hopefully now we made some progress, but I still think there is a lot to do and learn, is about the equilibrium effect. For example, how much of the costs that are imposed on the bank will be passed on to borrowers? And could there be any feedback effect between leverage regulation that could be heterogeneous across lender and the structure of the competition in the market? So what I did in my job market paper is really focusing on one side, and I'm going to talk a little bit more about the benefit as well. So the cost side of this type of regulation, try to answer the question, how do these lenders pass through this cost on to borrower? And are there any unintended consequences, such as regulatory arbitrage and reduced competition in the market? So to tackle this interrelated question, again, I was back in the UK using pretty amazing loan level data on the universe of originated mortgages. So very similar to the one that you heard to Claudia before used, without information, unfortunately, on broker. But pretty interesting information on the supply side on lender capital requirement, not only across different lenders, but also across different products within a lender. So using this data, I developed a new identification strategy that exploits this variation both across bank and within bank across different mortgages with different loan to values to identify the effect of capital requirement on mortgage prices. And the way to do that is through a key parameter that I'm going to talk when I move to the model, which is the unobservable marginal cost. And that's why I leverage this identification into a model inspired by the industrial organization literature, where there are basically two key components, which we've been taught since the very beginning of our courses: demand and supply. So on the demand side, there's going to be a joint choice of the mortgage product along a discrete dimension, and also, importantly, the loan amount. On the supply side, lenders are going to price these mortgages, accounting for the key risk, which is also one of the topics of today, so default risk, refinancing risk, which in the UK is a very concrete possibility, and also the leverage regulation in place. Once I put together the theory and the data, is like the last part, which is, I would say, the fun part after usually quite a lot of work, which is to think about counterfactual policies and quantify different trade-offs and perhaps make also some welfare statement with limitation that the referee made clear to me, and I'm going to share a little bit with you as well. Okay, so let me start sort of super simple with an example. Take two lenders, like a small and a large lender, that are making an identical mortgage of £100, or I should say dollar maybe now, with a loan to value of 75%. In order to make this loan, they're going to collect some dollar to finance the loan. And suppose that there is a common capital requirement of 8%. Both lenders are going to raise $8 in equity, and the rest they're going to collect some debt. However, what happened after the global financial crisis, I'm not going to go into the detail of the regulation, but you can think about Basel II, is that these capital requirements are risk-weighted. And what was the idea? I think very sensible: link better capital to risk. What happened, though, again, in this stylized example, is that the small lender has a risk weight, think about now for an identical mortgage, of about 35%. So the small lender needs to collect £2.80 of equity, whereas the large lender, which is using what's called an internal rating-based model, has a much lower risk weight of only 13%. So for an identical mortgage, and I'm going to try to convince you that that's what I go after in the empirics, only about $1 of equity is needed. Why do we care perhaps about this heterogeneity in regulation on the supply side? Well, going back to an influential paper by Kashyap and co-author, if Bank A is forced to adopt a capital structure that raises cost compared to a competitor, suppose Bank B, this can really affect the ability to operate in the market. And in this case, the statement is the bank, for a 20 basis point difference, can lose most of its business. So I think this is ultimately a quantitative question, and that's the question like I go after with my model and my approach. Let me now sort of show you the model and the mechanism in pictures, which I think is very useful when you do structural work to convince the audience that there is something indeed in the data before you jump into all the more perhaps complicated equation. So let's start from the cost side. So what I show you here is the regulatory risk weight as a function of the loan to value. And you can see that the small banks have a higher risk weight than the large banks that adopt internal rating-based model. And I like to think about it about the, going back to the theory of absolute versus comparative advantage. So you see that the large bank, across the whole leverage distribution, they have usually lower risk weight, but more so for the low loan to value, so low risk mortgages. So this may have an effect on the unobservable marginal cost. First thing to check, is this reflected into prices? So what I show you here, again, as a function of the loan to value, is the interest rate, which is conditional on a bunch of other characteristics that can affect the equilibrium interest rate. And what you see indeed is that for low leverage, the large banks seem to offer the more competitive product. These gaps shrink as we move up to the loan to value distribution and eventually even flip for very high risky loan. And again, maybe it's hard to see throughout the screen, but even just a 30 basis point difference, if you go to the so-called best buy table in the UK, can move you from best mortgage available to beyond position 10. So you need to flip to the next page online to check the offer. So the final step is these different prices reflected into quantities. And again, just in a very reduced form way, I'll show you the portfolio share of large and small banks, again, by loan to value. And you see indeed that there is a lot of specialization of small risky loan, like the 90 plus loan to value. Is this driven by regulation? Short answer is perhaps. What the purpose of the whole model is really to try to tease out the different determinants and isolate and quantify this channel. So let me just briefly preview the result. What I find is I estimate the shadow cost of capital requirement, and I find the percentage point increase in risk-weighted capital requirement increase mortgage rates by about 10%. And this is going to be, I'm going to come back to that, an upper bound on the cost. Because at the end of the day, in my model, there is one key margin of adjustment, which is the pass-through from cost to mortgage rates. And then with the model, I think about some counterfactual. I'm going to just talk about the first one today. Again, if you're happy to check the paper or reach out to me, that would be amazing, which is how this policy-driven cost advantage, if it's switched off, and I can do that in the model, is able to explain about 20% of the concentration in the market. So leverage regulation indeed can shape market structure. So in the spirit of exactly a lecture for a PhD, I want to go through the literature review, perhaps briefly. Three main literature my paper relates to. The first one is the one that we've seen a lot already today, consumer choice in the mortgage market. My focus is more on a new modeling approach based on the IO literature and on really thinking carefully about the supply side and how supply side respond to the demand side, for example, borrower elasticities. In this way, I contribute to the growing literature. Now I will have to add many, many more papers that study financial market adopting a structural approach. In my case, I have this discrete continuous choice model that back then was sort of an innovation and a new identification strategy. And then finally, the literature, again, massive, especially after the crisis, on this new type of macroprudential regulation. My focus is really to understand how this regulation interact with more the competition and the market structure aspect of the market. So I really want to try to squeeze what I can. So I focus on a couple of things. The model, and I want to sort of convince you how it's important also for the structural analysis to be fact-driven, so driven by empirics. And then I have time for counterfactual and hopefully say something also in the conclusion. So the way I started to think about this is just really looking at previous great research on the same industry and playing a lot with the data, reaching these sort of 4 facts. That there are interest rate jump at the maximum loan to value, as I showed you before. Borrowers respond to that by bunching at this maximum loan to value. Some borrowers seem to buy dominated product, and I'm careful in the paper by what I mean by that, but some borrower may value brand and be happy to pay high interest rate for that. And finally, even in a developed economy like the UK, the branches seem to affect the choice of the lender. So this 4 facts inspired 4 assumptions in my model. That the pricing is not only at the lender level, but also the loan to value. That the leverage choice is somewhat discrete. I want to have brand fixed effect to account perhaps for some substitution pattern that do not respond perfectly to prices. And finally, branches may affect the utility by affecting, for example, shopping costs. So what's the goal of the model? Is really to give me the 2 primitives that are driving a lot of the counterfactual results. And in this case, it's going to be on the demand side, borrower demand elasticity. How do they respond to price changes? And on the supply side, what are the marginal cost of the lender that could be affected by the regulation? And not only in the mortgage industry, but in many industries, marginal cost is really the unobservable object that we're after. So it's going to be a static partial equilibrium model where there are 2 key components. On the demand, borrowers are choosing which mortgage to take from their choices. That's sort of a discrete choice, and how much to borrow. That's the continuous choice. And lenders are offering differentiated mortgage product, competing on interest rate to maximize profit, and they're accounting in their pricing function for different risk that I really want to emphasize for you guys later. Okay, so the demand side, I start from the indirect utility for borrower I that is buying a house in market M to take product J. And this utility is really a function basically of a series of mortgage characteristics like price. Borrower dislike a higher interest rate. They may like different other aspects of the contract. And there are also characteristics that I don't observe, and I'm going to account for that in the estimation. And finally, as I mentioned, the branches are going to affect the application cost, and so perhaps the choice of the borrower as well. And all these additional terms like income, demographics is really just to allow for flexible substitution pattern. So despite similar preferences, you and I may differ for other aspects and therefore may have different elasticity. And this type of model are fairly rich in allowing for substitution pattern. The key assumption when I take the model to the data, I need a few more that are in the paper, is that borrower maximize indirect utility. So they choose the product that is their favorite among the choices that they have available. And then that was the discrete continuous idea. At the chosen product, by using row identity, I can also derive their optimal loan amount. So that's the demand side. Let me now move to the supply side, where I think account for a lot of the characteristics that the finance audience really is interested in. So the pricing is going to come from profit maximization, and the lender are going to set an interest rate for each product that they offer. Demand is going to come from S, which is the market share of product J in market M, and is a function of both the interest rate associated with the product and the competitor interest rate. That's sort of standard, even if you're talking about cars or cereal. What's more here is a quantity choice that's going to affect how much you borrow, and also, very importantly, the possibility that the lender is not going to get the profit because the borrower is going to default. So you're going to get the interest rate payment only if the borrower does not default, but you have to pay the marginal cost in any case. So that's sort of an adaptation of a more standard framework to the finance industry. And what I just showed you before was an unconstrained problem. But in the financial industry, in the mortgage market in the UK, lender are maximizing subject to risk-weighted capital constraint. And I can capture that by assuming that the capital at the lender level is greater than a minimum capital requirement, which is risk-weighted by this term rho that is multiplied by the mortgage they originate. So the joint equation at the top and the bottom are giving me the constraint problem of the lender. And I want to spend some time, even if it might seem a little bit ugly, on this equation because it's really the key one. So again, going back to serial and car, what lender, or in that case firm, are doing is a markup over the marginal cost. Taking this model seriously to the mortgage industry required first, at least in my geomarket paper, in my view, a continuous choice. So when Barclays raise the interest rate, some people are going to move to HSBC, but some people that are really attached to Barclays may stick to Barclays, but now borrow a lower amount. So that's the role of the continuous choice. Very importantly, after all the paper that we've seen today, there is also an effect on default risk. So changing interest rate are going to affect the effective marginal cost, which are now scaled up because some borrowers are not going to just pay back. And secondly, and go back to Arpit paper if you want to try to disentangle the forces. I'm not going to be able to do that in my paper, but I'm going to count that lender realize that when increasing interest rate, they may increase default. And this, again, could be due to moral hazard or adverse selection. And finally, regulation is going to play a role affecting the equilibrium interest rate. And this parameter lambda, the Lagrange multiplier on the constraint, is going to give me the shadow cost of the leverage regulation. So if you look at this object, a lot of the stuff are going to come from the empirical, and the key and observable is going to be the Lagrange multiplier and the cost of originating the mortgage. And this is basically what I'm taking to the data. So I don't want to bother you too much with how I do that. There's a lot more in the paper. I want just to mention that on the demand side, I face standard identification concern, like correlation between an observable and the interest rate, and perhaps selection due to the joint modeling of quantity and discrete. And I have an IV strategy to account for that. And similarly, on the supply side, I adopt this sort of policy-driven variation to identify the cost of capital requirement. Okay, so let me really mention a couple of results, and I want sometimes actually for more the discussion at the end. So my estimate is about that the 1 percentage point increase in risk-weighted capital requirement increased the marginal cost by about 26 basis points, which is 11% given a baseline of 242. And I do some heterogeneity, which is consistent with the prior paper and also an IV as a robustness. And one advice is sometimes even checking the coefficient on characteristics can give you an idea of how reasonable the marginal costs are. So in this case, the fact that they are increasing with leverage or the fixed period is sort of a reassuring result, given that that's the output also from the structural model. Let me just really briefly mention one counterfactual, and the second one is in the paper. So how do leverage regulation interact with market structure? And really, I think for this type of counterfactual, a structural model is really handy, if not necessary. So I started with you guys showing this picture. This is the actual regulation in place, which, according to regulators at the bank around the world, may have generate some unintended consequences. I think the problem here is that we can address this problem in very different ways. And sometimes we observe one of them in the data, sometimes none of them. Once we have the model, we can play instead with it. And that's what I do. First, in this counterfactual called all standard, where I basically force the big banks here at the bottom to adopt the same risk weight of the small banks. So I'm sort of killing the gap by pushing the big banks up. But an interesting alternative that was back then under discussion is, why don't we do the opposite? So we provide the small banks with the risk weight similar to the big banks, and let's see what happens. And that's exactly what I can do with the model. So just very briefly, in the first counterfactual, cost and prices increase and the markup of the banks go down because now they are forced to hold more equity. Whereas in the second counterfactual, there is a smaller decrease in prices and an increase in the markup as a result of the reduction of the risk weight for the small player. Both policies are successful in promoting competition in the market. And I found interesting and important here the magnitude, because the first policy is a pretty big change, and it has indeed huge effect on Erfindal index and the share of the top 4, which declines, for example, by almost 20%. But even the second policy, which may seem a little bit perhaps less invasive, has quite large effect in terms of market structure. So with the top 4 banks losing about 14 percentage point of their share. With the model, I don't have to stop that. I can look at welfare, at least as measured by lender profit and consumer surplus. And what I find is that the first policy is very costly for both borrower and lenders due to this increase in capital requirement. Whereas the second policy has fairly minor effect on borrower and lender. If anything, it's raising profit and consumer surplus. And finally, again, because the finance audit, the model allows to talk about risk. And what I find is that as a result of the higher interest rate, default goes up when I make all banks adopting the standard approach, whereas it slightly decreases as a result of the reduction in interest rate when all banks adopt the internal rating-based model. Finally, as I said, my paper is really tilted toward the cost side, but I compute a measure which is the buffer, so the difference in equity between the equity that is held in equilibrium by the bank and the expected losses. And what you see is the following. The first type of counterfactual increases indeed the equity buffer of the bank. So one of the positive consequences, despite it's costly, is that it perhaps makes the bank safer and more so the big banks. However, you can see that even the second counterfactual, which from a private point of view is less costly, or if anything is increasing surplus, is reducing the buffer, but only of the small banks, whereas not much is happening in the big 4, and the big 4 themselves are losing market share. So they are becoming not riskier, but less systemic. So evaluating the two counterfactual jointly has really important implication for the policy that we want to perhaps recommend to a regulator. So let me conclude by saying that, again, I provide the new estimates through a structural model and an empirically, hopefully, quite credible identification of an important parameter, which is the shadow cost of capital requirement. And then I can have fun with the counterfactual, thinking about the interaction between leverage regulation and competition in the market, and showing that leverage regulation that is perhaps endogenous to the lobbying effort of the big banks has indeed huge effect on concentration in the market. And I have a second counterfactual, more related also to Anthony's paper, on the interaction between lender-based and borrower-based regulation. But in the 5 minutes that I left, I actually want to talk to you about the most important slide of my talk, which is the one on limitation and open question. So I will need half an hour more to report all the feedback from the many referee and talk that I went through. So I picked a few that hopefully are going to spur the discussion, and some of them are also a little bit on self-advertising, so I want to just mention it. First thing that goes back, and Johannes was there, to the MBR Household Finance meeting, I think last year, not the previous one, was when Brigitte Madrian said that household finance and IO are usually at the same time. But it was amazing how going to the household finance now you can see a little bit of both. And we can learn a lot perhaps from this model, but we're still not talking about cereal and cars. So maybe there are other dimensions of competition that in this, at least in my market paper, I haven't accounted for. Like I emphasize a lot the interest rate, but financial contracts are often multidimensional. Think about initial rate, reset rate, origination fee, and so on. So in some new work that I have with Alessandro Gavazza and Paolo Surico, we actually look at the multidimensional pricing through interest rate and fee, and how this can affect the pass-through of, for example, monetary policy. Or there is interesting work, again, there's a bigger literature, I just wanted to mention for you guys a paper on advertising expensive mortgages. So perhaps non-price characteristics could be even more important in financial market than in a more traditional market. Second, I think really similar to Anthony's point. What about outside the mortgage market? My model is very partial equilibrium, but household regulation can be welfare improving or decreasing because there is reallocation. So at NYU, Acharya has a very nice paper using data from Ireland. And I have very preliminary work. I didn't put the date. I hope it's going to be ready with the vaccine in the beginning of 2021 on thinking about synergy from the supply side between household and small businesses, which you can think about small businesses as behaving very similarly to household. And so something that we learn in this course for household finance could be transferred for demand or supply side reason to actually the small businesses that we care about also so much in these days. And then finally, the question that I always put my hands up, and if I can, I say that the connection is not working well, is about general equilibrium effect. So again, there is great work here. One of my really favorite paper was my last year of the PhD I was looking at by Dan Greenwald, was to understand leverage regulation and business cycle implication, or more related to capital requirement, Begenau and Landvoid had a very interesting general equilibrium work. My feeling here is there is an important trade-off between IO and GE. So how complex and strategic you want the market structure and market interaction to be versus how much you want to aggregate stuff and try to go after a general equilibrium question. But I think this is an important trade-off that maybe some of you want to think about. So the bottom line is really that I think there is a very long to-do list for scholars that are interested in this work at the intersection of finance, household finance, IO, and macroeconomics. And thanks again, Johannes and Teresa.
Thank you very much. So, one of the things that was very salient both in your presentation and Claudia's presentation is sort of how much and how much sort of the emphasis was first to show sort of reduced form patterns in the data before starting to jump right into the model. I think this is sort of a very different way to, if you spend too much time in Minnesota, you start realizing that, like, if you haven't shown the model on slide 3, people will shout at you and say, show me the model, show me the model. It's different to presenting a macro paper, right? You really do want to spend quite a bit of time sort of showing the reduced form empirical results before you then start going into the model. And it might even be that for the the types of shorter presentations like this one here, you may even want to just spend much more time just on the reduced form empirical patterns, both because getting into model mechanisms it's just very hard to do within sort of the very limited period of time that you have, but really kind of showing people what the underlying patterns in the data are that allow you to speak to these broader patterns, I think is is really, really important.